What if your entire financial life was suddenly locked? The account where your paycheck is direct deposited is off limits. The bills you had set up to autopay are now notifying you that you're past due because of lack of payment. And worst of all, you did nothing wrong. You didn't even have a role to play in this. That's a situation with 10 million accounts that are currently affected by the bankruptcy and collapse of Synapse. You might be one of them. Yo, I'm Brendan, and I've been studying personal finance and investing for 15 years, and I've been making these kinds of videos for you for 5 years. Today's video is about the rise and fall of Synapse in the American finance world and the massive effect it's had on innocent clients caught in the shockwave of its demise. But can I tell you a secret? Because I think that this is actually emblematic of a bigger issue that we're going to continue to face in the fintech space, in the banking space, with all of our personal money and the apps that we choose to use on our phones. This is not going to be the only instance of this that we all come across. And at the end of this video, I'll explain exactly why that is and what I think we might be able to do to prevent that from happening. Synapse was created in 2014 as one of the first banking-as-a-service providers. That's BaaS. Well, imagine that you're a new fintech startup and you're trying to get all the necessary permissions and paperwork and charters set up, and then you have to build all these systems to take financial deposits, to give out loans, to offer debit cards or credit cards. It's a crazy expensive and time-consuming gig. And guess what? Regular banks don't really want to work with you because they thought it was too tricky to work with these high-tech fintech companies. Well, that's when Synapse stepped up and decided to play Cupid between the two parties. So they connected the fintech startup, the new high-tech app, with a cool sponsor bank like Evolve. And the way Synapse does that is they form an FBO account at that sponsor bank like Evolve. And FBO just stands for the benefit of. So it's for the benefit of us. And they pool all of our customer money together there at that bank. And it's Synapse's technology. It's this middleman technology that actually manages individual accounts. And so they operate basically invisibly. And so initially this banking as a service relationship was a win-win for everybody because it lowered the entry barriers tremendously for all these new fintech companies, and it ushered in this whole new era of new banks and attractive new perks like higher interest rates and lower fees, new investment options, gamified options like with Yotta, and it basically made this whole new industry able to happen way faster than it could have otherwise. Besides playing matchmaker and connecting these companies, which facilitated adding all these new features to fintech apps, Synapse also grew because they secured $51 million in VC funding, specifically from Andreessen Horowitz. And that group was really confident in Synapse. They even called them the Amazon Web Services of banking. Just 5 years after it started, Synapse was valued at $180 million, and by the end of 2022, they served 18 million end users and had over 200 team members. We're talking about a big volume of money here. They processed $76 billion in transactions. And up until recently, Synapse worked with over 100 companies. And because of the tremendous service they provided, a lot of these new apps came out that served very specific groups of people. Opportune, Commune, Majority all catered towards Hispanic customers. Totem was catered towards Native Americans. Monzo was all about travelers and fintech together. Copper and Greenlight were marketed towards teenagers. And Yotta was gamifying banking with daily lottery tickets. Even cryptocurrency investors were able to benefit from Synapse through Juno because they claimed they promoted seamless cash to crypto transactions. But as with any party, the music couldn't last forever, and in 2022, things took a major turn for the worse. The beginning of the end for Synapse was back in 2022, when one of the major banks that it worked with, Evolve, decided to sever ties with them and to keep a $17 million payment for what they claimed was a $14 million hole left by improper account management by Synapse. Apparently that little divorce is still incomplete 2 years later, and the claimed reason is that Synapse can't match up the numbers on its ledger. This is obviously a massive red flag if true, because if that's one of the core functions of the service, it needs to be able to do that. If it can't keep transactions in line, what have they been doing? The next problem for Synapse came when their single biggest banking service provider, Mercury, claimed that they weren't being compensated properly for rebates that they were owed from Synapse. So what happened was the federal funds rate was raised, which meant that the potential for people to earn interest was raised, and Mercury expected to get a chunk of that. They wanted a piece of that rebate, they were calling it. Well, allegedly Synapse didn't want to do that, and so lawsuits started flying, and they're still ongoing. In the meantime, Mercury went right around them, stopped working with the middleman Synapse, and started working directly with the bank itself, Evolve. And so when they started doing that, and they didn't need the middleman anymore, it raised an obvious question. If you can just work directly with the bank in question without dealing with a problematic person like Synapse, who needs a middleman? Can't every fintech service do the same thing and just connect directly with the bank? Well, now the whole idea of the banking as a service industry was in question, and the subsequent movements in that direction by other Synapse clients was the straw that finally broke the camel's back. Synapse went into a downward spiral, and before too long, they needed a financial savior to purchase their assets and take over. Thankfully, there was a deal to be had, and TabaPay came in to stop the bleeding. If you don't already know, which I didn't know, TabaPay is another financial services provider for fintech firms, so it makes sense that they would be interested in acquiring the Synapse assets, but it wasn't as simple as maybe it seems, because to seal the deal, Synapse had to go through a Chapter 11 bankruptcy reorganization, and TabaPay was planning to scoop up Synapse's assets for a cool $9.7 million. Way less than the VC funding kind of valuation that Synapse had bagged over the years, but that's what it was worth. But this acquisition process by TabaPay didn't go smoothly because there was ongoing issues with the accounts through Evolve Bank. These FBO accounts, these for the benefit of accounts that Synapse would open for its users, remained unresolved between themselves and Evolve. And if that relationship still remains a little bit fuzzy, which I think it probably should at this point, think of it this way. Evolve is a real bank with real clients and real FDIC protection. Synapse had a relationship with them to facilitate all these fintech apps, but it became a total mess. Millions of dollars of normal people's money that was in question because Synapse might have not kept track of their ledger properly suddenly became kind of the grudge match between Synapse and Evolve. The only way for that to be smoothed over enough for this new deal to go through with TabaPay is for someone to fill that hole with millions of dollars. Now, who's going to pony up millions of dollars to fill that hole and make this deal go through? Well, unsurprisingly, when you start asking a bunch of people for millions of dollars, that's really where the crap hits the fan. TabaPay pointed the finger at Evolve and wanted them to pony up the cash. Evolve points the finger back and claims that the accounts in question were already fully funded and they didn't need any more cash. Then Synapse drags their ex into the mix and claims that Mercury took an extra $49.6 million that they shouldn't have whenever they broke up. And of course, Mercury denied that claim. And so now you have everyone accusing everyone else of needing to do something or having taken too much money that they shouldn't have taken, and things got way too messy, way too quickly, and TabaPay backed out of the deal on May 8th, 2024. After that, Synapse fired all but a few employees, but the worst part is they remain the middleman for dozens of services. They are still responsible for at least hundreds of millions, if not billions of users' dollars. And then on Saturday, May 11th, the connection between Synapse and their partner bank Evolve stopped working altogether, and the accounts with that connection were frozen. But the somewhat ironic thing is that if the relationship with Evolve had just stayed the same as how it started, a lot of the problems could have been avoided. Because the accounts that had that initial connection with Evolve, they use what's called a DDA, a demand deposit account, and Evolve has recently been returning users money that had these kinds of accounts. They've been making people right. And in contrast to that, Synapse accounts that had been transformed into brokerage accounts in the fall of 2023 remain frozen. If you used one of these services that had that connection with Synapse, you might have gotten a notification. So like Copper, Juno, and Yotta users got this notification, myself included, that said, hey, your accounts are going to be changed into this new sort of a brokerage account, but it acts like a cash account, and you're going to get these extra benefits for doing it. And so we all just sort of said, oh, okay, I guess we're along for the ride. No one can pinpoint the exact motivation for Synapse to move to that kind of system, but odds are they wanted to strengthen their own business. The interesting thing is that even though Synapse did that, and now they're in a world of hurt because of it, this is a move that I see all over the fintech world now. M1 Finance, Wealthfront, and other popular investing services use this similar kind of structure where they set up a brokerage as a cash account setup. Then they use a network of partner banks and tout large dollar amounts of FDIC insurance and added features and all this good stuff for us as benefiting customers. But it makes me wonder if the added complexity of all this bookkeeping is worth it. Think about having to keep track of our money across upwards of a dozen different banks, the added complexity of the whole brokerage account being worked into it, and needing incredibly accurate bookkeeping. That's the exact kind of bookkeeping that apparently Synapse isn't doing properly and is creating all these lawsuits and thereby freezing our accounts. Now, those three apps that were affected by that change into a brokerage cash situation, Copper, Juno, and Yotta, have all in the meantime been forced to basically transition into completely different services, not like the ones they provided before, or they've just totally frozen their accounts because they can basically do nothing until the whole matter with Synapse is resolved. Their hands are tied. You might have thought that there would be some light at the end of the tunnel on May 17th when there was a bankruptcy hearing for Synapse, but nothing tactically useful came out of it. The frozen accounts and the tumultuous relationship between Synapse and Evolve and Mercury, it all remains. But why? Why can't somebody step in and make a change happen here? Why can't we unfreeze this? Why can't we make a resolution happen, especially if things are FDIC insured and regulators can get involved to solve the problem? Well, I think that's why the situation feels like it shouldn't have happened this way, because we have federal regulators and systems that are in place to protect us consumers and all of our deposited money. But one thing that's been highlighted as a result of the failure of Synapse is the massive regulatory blind spot that's been created by this banking as a service sector. These middlemen who connect the traditional bank with the new fintech services are basically totally unregulated. It's not that government regulators are taking a nap or ignoring the problem or dragging their feet. They have no jurisdiction here. Because these banks that team up with the fintech companies through a service like Synapse keep their deposits under $10 billion, that means they fly under the radar of the Consumer Financial Protection Bureau. Evolve Bank isn't about to go belly up, and so the FDIC isn't stepping in. They have no reason to step in, and they have no jurisdiction to do that. The Federal Reserve is the main group that's supposed to be watching Evolve, and at that recent bankruptcy hearing, a lawyer from the Justice Department read out a letter from the Fed, and it basically said, we don't have anything to do with the fintech companies, and we don't get in the middle of disputes between businesses. If we eventually do find out that Synapse or other fintech companies have been breaking consumer protection laws or otherwise tricking people, then the CFPB has some power to fine the companies or to force them to pay us back, but that's going to take a lot of time. Or at least historically it's taken a lot of time, and so that's my expectation now. Time is not what most of us have right now with locked accounts. We need to pay bills, we need to pay mortgages, we need to have our paychecks direct deposited into an account where we can reach it, and we can't do that right now. So in the meantime, a lot of people are having to take out loans or use credit cards to try and make ends meet. And so my question is, who's going to be held accountable for those costs that consumers are having to incur in the meantime just to make those ends meet? Is a bankrupt Synapse company going to be held liable for that? Are they going to reimburse people? I doubt it. I feel terrible for anyone who's had their money tied up by no fault of their own. I was a Yotta user for years, and I ended up having tens of thousands of dollars in the service for a time, and I ended up taking my own money out just because I felt like the service was going downhill. I don't know how much of that is a connection or a result of Synapse, but I just thought that the service wasn't worth using anymore, and so I withdrew basically all my funds just before all this happened. Now, all the funds I had in it at that time were like $7 because I'd stopped using the service because it wasn't a good service for me anymore. But as far as I understand, if you still have money in one of these services that was indeed FDIC insured, as far as we know at this point, we should be getting our money back. But it's going to take a while. My hope is that a judge or a regulator group or someone steps in quickly and forces the issue so that a resolution can be found as quickly as possible. Yes, this is technically a dispute between businesses, but the far deeper implications of this are that those businesses basically represented the banks that the regulators have control over. Is Synapse technically a bank that falls directly under the regulators' control? No, but they're functioning that way. And so I hope there can be a connection that's found in this gray zone that brings us a resolution. I think the bottom line is this. I think this whole fintech middleman bank sponsor setup is almost perfectly designed to avoid keeping track of what's going on. If one part of that whole financial train derails, it's unfortunately the customers who suffer. And this isn't the first time that there's been an issue with a financial middleman intermediary and it's ended up hurting the average person, because in 2015, a software problem at the prepaid debit card company RushCard left hundreds of thousands of users without access to their money. And a lot of customers who were often low income and didn't have a lot of other options couldn't buy basic necessities. They couldn't buy food. I don't know how they spanned that gap themselves, but eventually the company was fined $13 million by the CFPB for that disruption. Maybe something like that can happen now. Maybe some of that money can get paid back to people. I don't know how all that works legally. I'm just hoping that the resolution comes as quickly as possible. I love the idea of a good new finance service. In theory, we have new technology, and that allows for efficient systems that benefit customers and they grow a company's business, and so we all win. But whenever we choose to operate outside the boundary of regulators and existing systems, we put our own money at risk because we place our trust now in the hands of a few individuals who may not have our best interests at heart. These people who start a fintech company have other priorities besides protecting us. They need to grow the company. They need to satiate the demands of their VC funding overlords. They need to push to keep up with the competition and all the features they're rolling out. They've got 1,000 other things on their mind besides ensuring that our money isn't caught up in a big mess like this one. And frankly, They aren't paid to look out for us, and so they don't. Maybe they knew all along that they were in this kind of gray zone and they weren't under the jurisdiction of regulators, and so they knew that they were free to operate however they pleased, knowing that they could keep their nose clean no matter what. I hope that's not the case. But I do think it's ultimately our own job to look out for ourselves and our own money and not rely entirely on regulators and lawyers to pave the way for us. It just leaves us with a tricky choice. Do we, A, accept the new technology and the features of these fintech services and hope nothing goes wrong? We get all the flashy features and the potentially better services in the meantime. We get to benefit from all the new tech. It's a very cool thing. Or do we, B, stick to the traditional financial services that are established, regulated, and flawed in their own ways? Maybe we miss out on the hot new stuff for the sake of reducing the risk of being caught up in a mess like Synapse. I don't think we can know what the exact right answer is at this point. What is so new and so unregulated and so dangerous that we shouldn't be using it? Who knows exactly? And on the flip side, what existing financial service or sector is a house of cards due to the greed and mismanagement that's brewing in its belly? That happens all the time too. Outside of reading tea leaves, our best option is to always remember to conduct our own due diligence and make the best decisions we possibly can about our finances and where we're putting our money. After all, it's not just about the flashy features and the conveniences of the newest, hottest stuff. It's about the safety and security of your hard-earned money and avoiding the problems that come up like this one unfortunately did. Stay safe, stay informed. Thank you for watching. Please subscribe, and I'll see you tomorrow.